NASDAQ down 5%, over 6% on the day multiple times. S&P down 3.5%. Dow Jones down 3%, over 1,000 points. The VIX was up 22.5%, going over 30. That we know that 30 is a pretty key level on the VIX because that is when a lot of these hedge funds, pension funds start to change their strategy to go more of a long volatility. Some of the biggest losers were the FANG, which we've been talking about a lot. The main thing holding up the stock market right now are the FANGs. Today, Apple was down 5.5%, Microsoft 4.5%, Google 4.5%, Amazon down almost 8%, Tesla down over 8%. These names are just getting absolutely crushed, just tanking the stock market with it. A lot of value held up relatively well, but was still down. And then risk parity. The risk parity is just having anti-correlating between bonds and stocks. This has been 2 days of the past 25 years, where the S&P futures were down 3% and the 10-year was also down 1%. That is horrible because a lot of people have a 60-40 portfolio. Usually in the past, when we saw stocks go down, they would be okay because bonds would go up or their yields would go down. But today, the complete opposite happened. The last 2 times this has happened is October 9th, 2008. We all know what happened there. In March 18th, 2020, we all know what happened there. This is extreme fragility in the system. Potentially somebody starting to blow up, forced liquidations, a ton going on today. We'll go over everything that we're doing with our portfolios, how this could potentially cause a GME squeeze, and more. Justin.
Absolutely, Josh. Probably the most interesting thing that I think you said was the, I guess, the feedback mechanism. In other words, if VIX hits a key level, let's say 30, then you have other players, whether they're passive, whether they're active. But the point is, you have algorithms that are pre-programmed to go long on volatility, and the very act of going long on volatility might produce even more volatility. Now, obviously, if you're going long on volatility, that's a very happy problem to have. But the point is that you have something that's designed to
a self-feeding mechanism.
And exactly.
And then something else are the way these dealers are positioned. A lot of the intraday flow of the stock market is due through options and dealer hedging. We hit a very, very key point of a gamma flip at the 4,100 level on the S&P. Because of that, usually these market makers are short volatility, and because of that, they buy the dip and sell the rally. That's why buy the dip works so well. So that was why we'd have these trickle, especially for the past 2 years, we would see these trickles up in the market. The difference today, and when we start to see this volatility time, these dealers hedge and their gamma flips. Because of that, instead of buying the dip and selling the rip, now they sell the dip and buy the rip. So as stocks go down, they sell. As stocks go up, they buy. This increases volatility, along with these hedge funds changing their strategy, and these mutual funds, pension funds, that start to sell when VIX gets over a certain level. And that could potentially cause this negative feedback loop, just firing volatility to the upside. Again, this is increasing fragility in the system. What can't shorts have? Increased fragility. Regarding GME, the more fragility there is, the higher chance that people say, you know what, you got to cough up more collateral, the less likely that they'll have.
Yeah, or maybe said, so that's what the GME take. If you wanted to say that maybe a bit more generally, if you're engaged in OTC swaps, like a total return swap or whatever, right? You might have a clause saying, hey, listen, Josh Bank and Justin Bank, we're going to settle up, once a quarter or whatever, right? But there's probably also language written into the deal saying, words to the effect thereof, if there's a material change in market condition as defined by, for example, the VIX going above 30, again, numbers on my backside here, let's say 5 times in the period of, let's say, 10 business days, this will trigger a subclause allowing for a more immediate settlement or whatever. But this is kind of the thing where you might have, a piece over here doing its own thing, a piece over here, again, doing its own thing. And let's just say it's all the same firm, but different divisions of the same firm, where the left hand doesn't know what the right hand's doing. All these things get together, and we have all of these interactions that are playing, and then you have these sub-interactions, these emergent properties that link between the two things. This is, I think, a huge problem, because until you actually go through it and see what exactly exists, you might have an idea, but you're not actually going to understand. It becomes very nuanced, and I don't think that anyone has the skill set to drill down into the nuances and see exactly what's that. So again, Josh, I would say that's why I come back to the thing. The most interesting thing I find from all of this, and I say this as maybe like a passenger on the Titanic, saying the most interesting thing I think about the ship sinking is the feedback mechanisms from all of this. In other words, that the very algorithms that are trying to protect themselves might be the very algorithms that are triggering the downfall that will end up not only hurting themselves, but taking down the majority of the market with it.
If you're saying, Justin, that doesn't really make sense. These big hedge funds and mutual funds and pension funds, they know exactly what's going on in their portfolios. And these banks, they're the smartest guys. They know everything that's there. I can prove to you that is absolutely not the case. You could be in the same building, and you could be the portfolio manager of this entire building, let's say a bank, and you would have absolutely no clue of these off-balance sheet transactions that happen on two different categories of the firm, and the hyper complexities of the financial system that we have today. It's leading to more and more fragility because everything's so financialized. It takes such small events to cascade and grow much longer than before. I mean, right now there's so many headwinds. I don't know if stocks are going to go up and down. Before we get into what we're doing with our portfolios, let's just go over the fundamentals for the long side and the short side of the market. I would say let's go for the short side first, as that is kind of what was happening today. The Fed is tightening liquidity. We know that, or at least in my opinion, is the majority reason why stocks were going up over the past 2 years since the COVID crash is because the Fed injected a ton of QE infinity. The government came out with deficit spending, adding more money into the system, able to purchase assets. And that's starting to dry up. The Fed's coming out and tightening. We're getting no new stimulus. We're trying to tame inflation. GDP starting to go down. We're having a lot of recessionary signals, like the dollar starting to spike uncontrollably, yields starting to go up, a lot of negatives. There are no real catalysts that look like they're going to drive us up. Earnings are starting to go down. So there's a lot of negatives. What about for the positives? Well, there's still a lot of easy money out there. It is not to say that we are now in tight financial conditions. No, we still have a lot more dollars circulating than we did prior.
One other thing to consider too is that, at least last time I checked, I think BTC was down almost not quite 8%, but was flirting with 8%. ETH was down too. And I'm sure the rest of the cryptos were dragged down too. And this is something that I find particularly interesting because forget how you feel on Bitcoin just for a second, or crypto in general. But one of the things that's been thrown out there is that this serves as a hedge, much like bonds would serve as a hedge to equity. So if one's cratering, the other one's going up, and vice versa. But here, everything's moving in tandem. The only slight bright spot I can say, and it's not even a bright spot, it just didn't get creamed as hard, would be the metals. Now, don't get me wrong. I think gold was basically flat, maybe down.
Yeah, everything was down. The only thing that was up was dollar. Usually, the yields would be down as well. Like usually because of risk parity, that was down. Dollar was really the only thing performing, which is why you have these long volatility positions. So I think there's a lot more headwinds in the market than tailwinds right now. But that is not to say that we won't chop around a little. I just don't see that we have a huge leg higher until there's a new dollar that really starts to be created.
Yeah, the other thing, Josh, and I don't know how to quantify this into quant speak or into market speak. So I'm just gonna have to talk about it in story speak because of my ignorance in this regard. But let's say you have people who are making active decisions in the market, the individual stock investor, retail, or whatever, picking out equities or whatever, right? But let's also say there is a passive thing that is driven by algos or whatever. And there's probably more components, but let's just say these are the two major components that exist. Well, I suspect that there's more power, or there's more financial power that's controlled by the algos. And if the algos, whether it's a passive ETF, whether it's, passive allocation to in turn passive ETFs, I'm not trying to get into the weeds. I'm just trying to say that if you have this autopilot function, which is driving passive investing in whatever modus operandi that it's operating in, if these passive autopilots suddenly start getting spooked by their own shadow, or better yet, think about it like this. Let's say, again, numbers are on my back. So let's say there's 1,000 of these passive algos. Obviously not the case, but just working for example. And let's say 10 of them get spooked. And 10 of them get spooked, so where they basically sell and dump everything. Think back to what happened earlier this week in, help me out, Josh, Sweden? Whatever, right? Think back to something like that. Okay, so if 10 algorithms spook out, it's not enough to spook the other 990. But suppose, let's say that if 15 algorithms suddenly spook and freak out or whatever, right? That might be enough to freak out number 16. And when 16 freaks out, that's enough to freak out, let's say, number 17. 17 freaks out, that freaks out 18 and 19. And so you have this cascading up, or you have this increase of volatility as the algorithm consistently freak out. The irony is, of course, if 16 didn't freak out at all, if 16 was just yeah, no, we're going to be cool with all this, that wouldn't have been the issue. But the act of 16 freaking out because 1 through 15 freaked out because that was the threshold it had to cross, that creates this is the snowflake that is hitting the snowpack and the beginning of the avalanche.
Yeah, exactly. So now let's go into our own portfolios. If you've been following for a while, Chris Cole's probably been the most influential on my portfolio because there's long volatility and you have these different components of your portfolio that perform well under different conditions. 60-40 used to be that. I mean, I would love to go back to a time where, and during times of financial instability, bonds go up, stocks go down. You could have that offsetting asset. We're no longer in a case like that. So I like to have a long volatility, usually through S&P puts. Sometimes I get more fancy if I'm bearish on a certain stock or sector, but right now, for the past few months, I've been doing just S&P puts. And
Just quick follow-up. Are you playing anything with the VIX, or are you just playing it with puts on the S&P?
no, that is basically the same thing, because
Gotcha.
VIX is pretty much tracking volatility on the S&P.
Interesting.
So as VIX goes up, buys going down most likely, or I'm making money on my puts. So I did not sell my put today because I'm down to one left, because as things start to go down, long volatility allocation starts to go up. So I don't want my long volatility position to be any more than 15, 20, 25% of my portfolio. So as everything else is going down, my long volatility SPY puts are going up, and I start to sell them. Today, I only have one left, and I'm holding it a little bit longer. It expires in like 2 months. So I still have a little bit of time, but I don't want to miss more potential downside. If we do happen to spike up and that put starts to lose in value, I would love to buy another one if VIX gets down to like 13, 14, 15, 16, 17, 18, even 20. In this current environment, I'd be a buyer at VIX at 20 in different circumstances. So that's pretty much what I'm doing. I've not yet bought anything. I would love to. A lot of these different miners, I mean, silver and gold miners are really tanking. And even though the metals are holding up pretty well, the miners are really tanking. And I love the extreme leverage going out 2+ years on options. These leaps have extraordinarily, I mean, you could get 100x return on these options if we see a situation where gold and silver really start to skyrocket, which is why I love optionality in options, because of the leverage. And I think long dated calls are mispriced in a lot of asset classes. So that is kind of the way I'm playing it. I've not yet bought anything. Once I do, I'll let you guys know everything that I buy. I'm looking on my watch list, and over the past few weeks, I have bought a few calls on First Majestic and another, and then just SILJ, just the junior mining silver ETF. But I'd love to buy more. I'd love to buy more uranium, gold, silver, GME. We have a lot of interesting things going on with the FTD cycles coming up in May and June. We'll do a full video on deep dive going over the dates for that, and I don't know, maybe a few days, Justin. And once we do, I will definitely be adding to my GME position as well, but on a more timely, because I do think if the market goes down, for now, GME will probably tank until that something breaks. If something breaks, then we could see an out of control spiral going up on GME, like with the Volkswagen squeeze. Once 2008 happened, Volkswagen started to skyrocket because fragility in the system led to the shorts not being able to manage their position any longer.
Yeah. And I would say too that if you have, not to get too much focus on GME, but if you, let's say, have some sort of OTC direct agreement, like a swap or whatever, right, between like, two counterparties, it's probably in the best interest of the counterparties, if one of them's blowing up, to try to unwind it, or to try to let the pressure out in a controlled manner, if not just for the counterparties, at least the primary dealers of the counter, assuming those themselves aren't primary dealers, but whatever, right? So I do think that there is an incentive for the system that once the system finally has to call, or once you have two parties in the system that fail, or one party that fails to another party, you probably want to have a orderly unwind. Now, that being said, is how will you be able to facilitate this? That's a different question, different video. But yeah, I completely concur with that.
Yep.
For myself, yeah. So basically for myself, Josh, again, as so many times, you're the market guy. What I'm in right now is I do have a metal position, and I manage that through options on First Majestic, which I really like, as well as I've got just some smallish investments in Junior and Explorer. So that's more so just for funsies. My BBBY and GME, with the majority being in GME, is kind of what I trade around the most. For the time being, I'm continuing to write cash secured puts and continuing to write covered calls. So that's been pretty useful for myself. Although I do think I am going to start being much more conservative with my covered calls going into the middle and the late of May. I wouldn't mind being assigned, just in theory, on maybe, let's say, a couple of covered calls, because Josh, as you accurately note, I do think that when the market takes its next leg down, I do think it'll take everything down, including the meme stocks. But again, if you believe that, let's say, swaps, for example, that have to be squared up every quarter or whatever, right, are going to be what's going to what causes the run up. You might have, let's say, a situation where all the meme stocks go down, but the effect, as would be realized through a swap, won't necessarily impact the market until the swap comes due, assuming one party doesn't call the other party out sooner. So again, this is all speculation. I want to be really, really clear. I do not know the intricacies of how these things work, but I get the concept. I definitely get the concept. So that's kind of how I'm playing it.
Yeah, so that's pretty much everything that's going on today. One last thing. I saw a tweet. I'm not sure if it's accurate, but apparently MicroStrategy will go bust, and they'll get margin called if Bitcoin goes below 21,000. I would not be able to get harder in that circumstance. And I swear to that would probably make my day. I would love to buy Bitcoin. If MicroStrategy does get margin called, I think he has it come in form. But if there is a margin call, I mean, we could see Bitcoin and cryptos tank 50, 60, 70, 80%. It's usually what happens in those bear markets. And I can assure you, I will be a buyer of quite a few cryptos in that circumstance. So Justin, I know would be too. We might do a separate video on that eventually. Without further ado, guys, thank you very much for watching. And if you have any questions, leave them in the comments because I would be more than willing to answer them, as well as Justin. He is not as active though. So thank you guys, and we'll see you on the next.